Hello, welcome to part 3 of cash flow statements, and we are discussing cash flow from investing. So, in cash flow from investing, we are looking at fixed assets, and the rule is very simple. If your assets have increased, that means money went out, yeah. And if your assets have decreased, money came in. Since you sold the asset, the money should be flowing in. Adjusted for obviously gain and losses, so, and if they have been financed by a debt or an equity, and the financing portion of cash flow statement deals with those kind of adjustments. So, usually the information comes in two forms. Either you will have a cost, accumulated depreciation, and a net book value. Cost minus accumulated gives you a net book value, or your information is appearing as a net book value. You can gain additional information on this from the notes, IAS 16 standard. Yeah. So cost is like opening balance, what you had at the start of the year. You'll get this number from balance sheet. You have purchases, you'll get this from notes, or you might have to find this out at some point of time. The assets sold would either you can find them, or it will appear somewhere in your notes to financial statement. It will definitely appear in your notes to financial statement, and you'll left with the closing balance number. This will again be part of balance sheet. So same goes for accumulated depreciation. So you have an opening balance, you have depreciation expense for the year. It will come from profit and loss account. Sold asset depreciation will be available in notes, and you'll have a closing balance of depreciation. Somewhere in 8th or 10th standard, you might have done simultaneous equations. So if you simultaneously solve this equation, you'll have a net book value equation. So opening balance of the cost minus opening balance of the accumulated depreciation, it will give you opening net book value. Purchases will be added on as it is. Depreciation expense is subtracted. Cost of asset is subtracted. Accumulated depreciation of sold asset will be added back. Cost of assets sold, and it will give you a closing balance of net book value. Might seem tricky, but it works for some, or you can always do it the old fashioned way using T accounts or something else, but it usually works. So equations are simpler. It helps them understand how things are flowing through the balance sheet and in income statement. So once you are done with this, if the rule is simple for either cash flow from operations or investing or financing. So we are looking at fixed assets. If assets increase, it's a negative activity cash wise. If its assets decrease, it's a positive activity. If they have been financed by a debt and equity, it will be dealt with cash flow from financing. See you in next video. Thank you very much.